All right, so today we're talking about level 2 understanding of the master pattern, the contraction, the beginning of everything. So as you guys know, we talk about 3 market phases. What are they? Contraction, expansion, trend phase. Contraction is the tightening of price. The expansion is when it leaves that contraction area, breaks the higher low of the box, that's the expansion. And then we're looking for that trend phase, which is going to be the space between contractions. So either to higher prices or to lower prices. Those are the 3 market phases, and that is the generalization of how the markets work. You can look at the markets and generally see with a reasonably good trained eye, you can see where the current contraction is that you're dealing with, and you can see whether you're in that expansion phase, and you can see is that expansion leading to a trend phase potentially, and then when it's over, you can see we go back into contraction. And that's really the whole point of ATS software, is to map those things out. We have a lot of other things around that, like ATS trend, liquidity lines, things that help with that, but that is the basics of what is behind the market framework, is these 3 market phases or 3 market behaviors. So we're going into level 2 understanding of that. Level 1 was just the general, what is the master pattern and how did it come about, things like that. So now we're getting a little bit more into the workings behind the master pattern and what it all means. So that being said, we're going to start level 2 here, master pattern, contraction, beginning of everything. Let's get right into it. So what makes a contraction point important? So let's look at the example here. Contraction is fair market value or a balance in supply and demand. And what's important to know is that this is under the market maker's direction. Now, we've talked about it throughout these lessons that the market makers control supply. They don't control demand as much, but they are the floodgates of supply. So they're controlling one side of the coin pretty much to a large degree. So if they control supply, they have a lot of power to push the market within limits, to create patterns, to create different things that can influence people who look at patterns to do different things in regards to buying, selling, opening new positions, closing old positions. So that's what we're going to be kind of digging into here through this lesson. So let's go to our next slide. Another thing we need to discuss is a market maker's portfolio. Okay, everybody has risk. Everybody is trying to make a buck in this market, and they're all trying to do it through winning positions. The only way money is made in trading is either, or in the markets, is either through commission or proprietary trading of some sort, meaning I'm buying something at a price and selling it at a higher price, or shorting something and buying it back lower at a lower price. So just opposite of that. So that's how money is made. No different than that for the market makers as well. We're all trying to make a profit on inventory or goods accumulated and then sold. So the market makers are always willing to take all trades, even if they can't find another willing buyer or seller to match a transaction request. This causes them to create 2 separate portfolios. We call these the positive selection portfolio, which is positions that they want to have. These are positions that they think they're actually going to make money on. And then they have their negative selection portfolio, which is positions that they do not want to have. This is the nature of doing their business. So the market makers can and will manipulate supply in order to organize their portfolio in a way that provides them with the most profit. Anytime too many traders are positioned the same as the market maker, they are pressured to manipulate things back into their favor. Now, just real quick, I know that this always has kind of like a nefarious overtone to it, like the market makers are always out to manipulate the market just for the pure fact of just stealing money from the sheep. Okay, that is probably mostly true. Okay, but they also have to perform this function to keep from bleeding out and losing all their money as well. Because when you are willing to take all trades, meaning that if there, let's say there's a huge buying demand and everybody that they process trades for, that market maker is sending buy orders to them. What happens when you have 75% of people? We see it on the sentiment. What happens when we have 75% of retail traders that all want to buy? You don't have enough balance in the market to organically match those traders. So what ends up happening is that if you got 75, 80%, 90% of, let's say, retail trader, and there's some smart money in there also mixed, probably, right? It's not an exact, but you get the majority of all this buying pressure. Where is the selling going to come from? The selling is going to come from the market maker doing their duty as they're supposed to, being a market maker. Their job is to make a market. And that means that I come to you with a request and they fill it. That's it. So, but the problem is, if they legitimately know the market is going to go higher, what ends up happening is that as they are not able to organically match all the buyers and sellers, they end up becoming net the opposite. So in this case, if there's a huge buying demand, they're becoming more and more and more net short. That causes a problem because if the market really truly is going to go up, they got to unwind this somehow. And so that's where we end up with our positive and negative selection portfolio. If we're in a huge macro trend going upwards and they're net short, that would be part of their negative selection portfolio. And so as a market maker, from a proprietary trading standpoint, they are now going to be looking for ways to dump those positions that they don't want to have. How would you do that? If you had a bunch of short positions and you control the floodgates of supply, you have this manipulative power within limits, but you're able to do this, how would you do that? The thing about it just for a quick second. The way you would do it is that you would take your power to manipulate the market within these brackets, these limits, whatever it is at that moment, and you would figure out a way to create a facade on the chart that gets as many people wanting to either close out their buy positions or create new selling demand, wanting to short the market. And that could be through new sell orders or stop losses. Either way, it's more transactions. So if you were able to push the market just so subtly, you're able to push it just enough to recreate that balance to get so many traders not so net long, then you can take the other side of all those traders from that manipulative activity and get rid of your negative selection portfolio, therefore ensuring that you're able to go on with your business. And the extreme of this is that if they're really, really good at it, they can make a ton of money from it as well, which is also, they will absolutely do if it's possible. So this is, what we need to understand is that this is part survival, this balancing of this negative and positive selection portfolio, and it's part greed and ability to make a lot of money. So that's what I want to cover on that. So what to understand about every contraction. Remember that market makers control the gates of supply. This means that a contraction is part the normal balance in supply and demand, but likely also artificial manipulation, which I've already kind of gotten ahead of myself. So we talked about that. So let's look at a contraction from two different perspectives, okay? On the left, we have non-manipulated supply. This market was pretty much just able to break out and go long, right? That means that there is organic demand in the market, and the market makers felt no need to manipulate and push it up and down, break highs and lows. What do we know that as? We know it as a multi-leg expansion. You get the first two expansion legs, kind of seals in what the intention is. How many expansion legs are we going to get after that? We don't really know. But that's why we navigate those expansion legs in trend. We don't know how far they're going to take it. We just want to be well positioned in that phase, right? In this case, no need to do it. They control it. It's their call. That's where you get these direct breakout expansions, where we have a box and it just goes. No need to manipulate. Now, in this case, we have manipulated supply. Same situation. Got a contraction. We got that pause. Fair market values established in the market, whether manipulated or organic. But market has paused, creating a mix or just a mix in beliefs. People are wondering, is it going to keep going up? Is this the top? What's going to happen here? So if too many traders are net long in this second example, what can they do? They can start building what looks like a downtrend forming. What's going to happen there is it's going to get new buyers or new sellers into the market, and it's also going to be able to run stops, which rebalances the market enough for them to take the ride up to the next level and not lose a ton of money. So everybody with me here so far? Okay, cool. All right, so that's pretty much the basic example. So let's dig into this a little bit more, in detail. So again, non-manipulated supply. Market makers are holding buy inventory. Traders are mostly short at this point. There's no need to manipulate the market because retail is already positioned opposite the market maker. Trader stop losses will continue to drive the market higher on the breakout. This kind of activity, real quick, is what we see on retail sentiment. If you guys look at the retail sentiment indicator that we have, you guys see anytime euro dollar, pound USD, pretty much anything goes into a heavy trend, you guys see what the retail does. Whether you're looking at the numbers on IG, my FX book, whatever, or you're looking at our sentiment indicator, you see how heavy retail trades against that, right? Well, what they're doing is that their stop losses, as they go short against this, the market makers have options. They can, if there's enough stop loss volume in the market above, they'll just continue to drive through stop losses. There's no need to manipulate. It just depends on where they're positioned. Okay? So at a given time, the market makers have options of how they can either manipulate things, how they could use the stop losses. It's all just a game of liquidity and balancing inside that liquidity with their positive and negative selection portfolio. Now, this can get very complicated if you try to dissect every little bit of this and try to work it out. Thankfully, that's what the whole master pattern methodology is for. We see contraction. We know if things are being manipulated because we see the multi-leg expansion. And we're not trying to call what's going to happen or try to predetermine. We're just trying to deal with what is happening. And we're putting that story together as it plays out. So I just want to make sure, because this can get kind of confusing as you think of all the different possibilities of how they can work within these different sources of liquidity, whether it be new trades, stop losses, all those things. So just keep in mind, the master pattern simplifies this whole thing. Okay, so manipulated supply. Market makers are holding buy inventory. Too many traders are starting to go long. Market makers determine the need to drive the market short to dump their negative selection portfolio and get other traders net short. They also pick up discounted supply to distribute into the future rising market. So the same situation, if we see that this has happened as it's playing out right here, we can conclude as it's happening, especially if our directional bias is long. Let's say that this is a 15-minute chart or a 30-minute chart and our daily and weekly are long. The moment we have that contraction box, we already have a bias outcome to the expansion and in trend phase because we're looking at the higher time frame flow of money. Is it guaranteed? No, it's not. But we are coming to that market with a preconceived bias based on the probabilities of the higher time frame. So if this happens where we get the breakout and we expect that the ultimate fulfillment is going up some way, somehow, and in some time, and we see that it was manipulated down short like this, and then it goes long, then we know why that happens. Why did it happen? Is because the market maker was a little bit too net short for whatever reason. So, and this can happen too, even if we have retail sentiment long. They have their own reasons for doing things. There might have been an opportunity to pick up and make more money. So it doesn't necessarily have to perfectly correlate with if there is really heavy short retail sentiment, that they will still not manipulate the market and push it down. They will, ultimately. So that's why we can't use details of retail sentiment to navigate every little ups and down. That's more just showing us the flow of the retail mindset. We still need to look at the details of the chart. So if this happened, where we had fair market value established, we had a manipulation short, and then it continued to go long inside the directional bias, you know what happened. There was either a money-making opportunity to drive it short, or they had to because they wanted to try to rebalance things. And that's it. So just want to get clear on that. So different contraction examples. Let's briefly go through this. So here's an example of manipulated supply. How do we know that? It's because we came out of the box below it, and then they pushed it back up to run stops, change the perception of the mass market, thinking this could be a turn, and then they push it down short. Here's an example of non-manipulated supply. They already manipulated above, then retail is probably heavily net long at this point. In this case, they didn't feel the need to do it, so they just let it hit. And stops took care of it, probably for exit liquidity. Okay, here's another one, non-manipulated supply at this moment. Breakout, goes straight into the trend phase. That's how that goes. Here's one little bit of manipulation there. They pushed it up, took it down. So you guys can see here, as we're looking at these, another manipulated supply here, the multi-leg expansion really in the master pattern methodology is the marker for not only sometimes indecision on the higher time frames from the bank's perspective, but also the rebalancing that is happening. It all plays into the understanding the one pattern. If you know that you're in multi-leg expansion, rebalancing is happening for a number of reasons. Again, it could be indecision on the much higher time frames, but also could be just a necessity of making sure that the market makers aren't net what is the likely outcome. So again, going back to this, I can't stress this enough, is that the magic in what we do, as far as the master pattern, ATS in general, is just understanding these general characteristics of the market, this expansion behavior, really, at the end of the day, it's the expansion behavior, and applying a directional bias to it. Meaning I'm calling red or black on the roulette wheel before it lands, because I know that we are in a likely series of all blacks or all reds. So I'm just going to call it right now, the moment I see the contraction. And then I'm going to trade the expansion like I already know the outcome of the trend phase. That is essentially all we do here. The tools, the ATS, the expansion line, the liquidity lines, the trend are all tools to try to help us do that more effectively. That is a bottom line here. So what you're learning right now is the details of why this happens. You know, mostly, especially you guys that have been here, these details are mostly not really important to know. But some people need to know. They got to know exactly why this is. And these are the technical reasons why this type of activity happens. But if you understand three market phases, you understand contraction, expansion, trend, all you need to know is that you need to navigate that expansion phase above or below value to get yourself in a safe entry so that you can just bake in the market and wait for the expected outcome and do your best to empower yourself to navigate through that situation. That's really what it comes down to. And I don't know a better way personally to approach the market than that. If you guys got something, hook me up. But this is the explanation, a sound explanation for why everything happens the way it does. And it gives you a very solid way to interact with the market and a way to justify to yourself why an outcome happened or didn't happen. And it gives you a very good way to continue to learn. When things don't go your way, especially, you can put a meaning behind why did I take that loss? What was learned? What new information do I have in regards to the sequence of events that will now empower me to go forward? And I've never seen another methodology that gives us that type of logic to work through. So that's really the magic behind it. Okay, so what's important is what was left behind in contraction. So we have fair market value here. As we break out, buying belief is strengthened as prices move up. Seeing is believing. That's all traders need to see, because they always favor, as a general rule, they favor that there is more confirmation rather than just getting trade placement waiting for an expected outcome. That's the difference between us practicing this methodology and most everyone else. Most everybody else, whether they want to say it or not, are breakout trading. They're either doing it as a strategy or they're doing it because they are drawn into the market. Nothing looks more tasty than a heavy breakout you could jump into. I know, believe me. So that's where, whether they say it or not, a lot of people are getting sucked into those breakouts. They see it going. It's like, I got to get in. And then what happens most of the time, it sucks back on them, even if they saw a little bit of profit. And now they're in an expansion and they're getting chopped up, right? The difference with us, we want the expansion. We want the bloodbath, essentially, so that we can get in and favor trade placement as opposed to confirmation. Our confirmation is a preordained belief, something that we've already come up with based off of a sound analysis of the higher time frame. So we need less confirmation because we believe in the higher time frame. And that's why I always say start with your higher time frame first. How do you feel about the stability of the higher time frame? How do you feel about the timing in general of that higher time frame cycle? We look at a new directional change on ATS trend, that first dot. That's why we call it the grade A trade spot right there. Why? Because it's a new directional change. It's fresh. And the probability is reasonably high that the next couple of expansions on our lower time frame are going to move in that general direction. Now, the more of that happens, the less probability that we get, which we need to be aware of. But it all starts in the higher time frame. If we do a really good job there on our timing and on our analysis, things should definitely lighten up on the lower time frame. So anyway, that's the difference between us, is that we are trying to use the expansion to get really, really, really good trade placement opposite of what the masses are doing. And by default, we are putting ourselves in line, not only probability-wise, but also from a risk management standpoint against the retail public, since they are buying the breakout on every side of expansion. As it goes up, they're buying. As it goes down below value, they're selling. We are always trying to flip that and therefore inherit some of that 95% lose rate in our favor so that we don't have that. We're just flipping the whole thing on its head. So what's important was left behind. We have the buyer's pain threshold here at value because we had fair market value established. As it moves above, people want to buy. As it moves below, people want to sell. So in this situation, what was left behind is a stack of future stops, which sell orders or sell volume. That right there, the game is about liquidity. On the sustained market moves, the players, all they care about is two things: liquidity to get in and liquidity to get out. That's all they care about. They do not care about the chart patterns other than what the chart patterns induce people to do. Why? Because the chart patterns manufacture liquidity. But at the end of the day, all they care about is how am I going to accumulate something at a discount, and how am I going to sell it later for a profit? And it stops there. So that's the eyes we need to look at the market through ourselves to understand what's really going on. So what's the takeaway from this lesson? Contraction is the beginning of the market maker cycle, the three market phases. Market makers can end up with positions that they do not want due to the nature of their trade matching business. In order to not lose money, they must rebalance their portfolio through manipulation of supply. Again, this is not necessarily nefarious all the time. They're not ultimately trying to steal money from everyone through manipulation. They do. But this is also a survival mechanism. Understand that to some degree, this is we have to deal with this to have access to instant liquidity. If we didn't have access to instant liquidity, you'd have to be calling up your friends on the phone and asking if they want to trade with you. There'd have to be some network connection between all the traders themselves. So the market maker is a good thing in that stance, but we got to deal with how they stay in business and how they make their money as well. So it's just that kind of that third party perspective that we need to be aware of first and foremost before our own beliefs of what the market's going to do. Our own beliefs are really irrelevant. It doesn't matter what we want to have happen in our time frames. The only thing that matters is how connected we are to the realities of what the banks are doing. That's all that matters at the end of the day. So by understanding their business and tactics, you will be better equipped to determine where price is likely going while avoiding their traps. And that pretty much wraps up this lesson. So I'm going to briefly open it up to questions. If you guys have any questions about this lesson, and then I think we could go to the next one. So Odin, always got good questions from you. Go for it.
Okay. Can you hear me?
Yep.
Does each time frame have its own contraction phase? What I mean by that is there like a 5-minute contraction phase embedded in a 4-hour and a 4-hour embedded in a weekly? And how important for us is it to understand that?
Yep. So great question, especially for those of you guys that are watching this, that are new to this. Is the contraction, the expansion, the trend, the three market phases are happening on all time frames down to the tick level. If you pull up a tick chart, you will see these three phases happening. It's always at play, and the difference is that the time frames that it takes to play out. So the key is not only understanding it's happening across time frames, but understanding the cycle placement on especially the higher time frame. Because if you know that you are in the trend phase or likely in a trend phase on the higher time frame, then you are much more likely to understand the probabilities of getting paid on the lower time frame and navigate those. At the end of the day, our biggest edge is a directional bias. So if we're aware of the cycles on the higher time frames, then we are going to be better at finding and trusting the directional bias so that we can find solid entries on the lower three market phase cycle, ideally in the expansion phase above or below value. And that's where it starts. So does that answer your question, Bowden?
Sure. Yep.
Thank you. Great questions, especially for the new people here.